Real estate is one of the most popular long-term investments, picked by 28% of Americans, but why do less than half that, just 13%, actually own rental property? Because it's just too damn expensive to get started. In this video, I'll show you 5 ways to get started investing in real estate for $1,000 or less. Then I'll reveal 3 secrets to success all real estate investors need to know. We're talking how to invest $1,000 in real estate today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, you know I love real estate investing. From my start as a commercial property analyst in college to my rental properties, there's just nothing like owning that physical piece of property. Now it's not all rainbows and unicorns either though. My rental properties almost pushed me into bankruptcy when the housing bubble burst, but it's still some of the best returns I've ever seen. I've averaged annualized returns of 15 to 20% between commercial and residential properties, and it's a great tax shield for your other income. But the big problem here is getting started, and you just can't do much with $1,000 or even 10 times that sometimes. Even my smallest rental is $130,000 and would cost $26,000 if I wanted to buy that with a 20% down payment. There are ways to beat this, and I want everyone here in the nation to experience that financial freedom from real estate investing. So in this video, I wanted to share 5 strategies I've used to invest in real estate for $1,000 or less. We'll cover some of the direct methods, so actually buying the properties for yourself, as well as indirect investment. But stick around to the end of the video because I'm going to be revealing my 3 biggest secrets to being successful no matter what type of real estate investment you pick. Now, I want to open this up to the community first though. Have you started real estate investing yet? If not, what do you think is that biggest hurdle, that biggest challenge to getting started property investing? So scroll down and let me know in the comments and I'll put together a few videos to answer your questions. So our first couple of real estate investments are going to be indirect. So you're not investing directly into ownership of the property, but into funds that hold these properties. Now these are great ways to build up that wealth so you can invest directly later on and get those properties themselves. This first one is a favorite here on the channel, investing in real estate investment trusts or REITs. REITs are real estate companies that own rental property, mostly commercial, and they'll usually focus on a specific property type. So you've got REITs like LTC that owns senior living and healthcare facilities, and you've got Boston Properties here, ticker BXP, that owns office space. You buy these companies, these REITs, just like any other stock, and through a cool trick in the tax code, these companies pay no corporate tax if they pass on their income to shareholders. What you get is a solid dividend, usually between 3 to 6% and even higher, and some price appreciation on the shares. Most of these companies are equity REITs where they actually own the property directly, but there's also another type called a mortgage REIT or an MREIT. Now here the companies borrow on short-term rates and then use leverage to buy much more in mortgages than that actual capital on hand, sometimes on the order of 2 or 3 to 1 times. So you get companies like Chimera Investment, ticker CIM, and yields as high as 8 to 12%. Now just like we talk about with dividend stocks, yield isn't everything, and these mortgage REITs can be highly volatile, especially around changes in interest rates. So I usually prefer those equity REITs because you get a good mix of price gain as well as that dividend. Pros of REITs are that you can get started with almost nothing. Share prices for REITs trade from just a few dollars to hundreds each, so anyone can invest in these on pretty much any investing platform. The companies are run by professionals. You don't have to do anything but just sit back and collect your dividends. Now the downside to REITs, of course, is that you don't get that same feeling of ownership that you get with a direct real estate investment. They also don't offer the tax advantages or the return that you'll usually get with your own rentals, though REITs do usually keep up with stocks for that total return. This next strategy is similar to REITs, investing in private funds and property crowdfunding. Now I really like this alternative and have been investing on a few platforms myself. These are professionally managed funds that own the properties and then pay out those dividends just like a REIT. The only difference is they aren't publicly traded on the exchanges and the funds tend to hold fewer properties. A couple of examples include Fundrise, which I've been using since last October. I started with $1,000 and have collected $20 in dividends and $24 in appreciation, so a 4.4% return in just 4 months. What I really like about Fundrise is the transparency here. You get updates on all the properties. The platform shows you which investments are debt and which are equity. You can even click through and get a full description of each property, including a market analysis and the financials. Fundrise has different property portfolios you can choose from, some focused on those higher dividends while others target price appreciation. The platform also has a new program, its 90-day guarantee. Now get started with as little as $500 and try it out for 90 days. If you don't like it, Fundrise is going to give you a full refund. So I'll leave a link to Fundrise in the description below if you want to check out that program. Another platform I'm using is Streetwise, a private REIT focused on non-gateway markets, so smaller markets with a value focus. The minimum is a little higher here, so you'll need that full $1,000 to get started, but the fund fees are low and it's paid a 10% annualized return since inception. The First Street Office REIT has a good mix of tenants with properties in both Missouri and Indiana. Now, pros of private REITs is that you get professional management, and I feel like management can do a better job with some of these smaller funds. They don't have those billions to invest like those publicly traded REITs, so they can pick and choose the best projects for higher returns. Cons though are that the minimums are going to be higher here, so you're looking at between $500 to $1,000 just to get started, and there's less liquidity in these. With a public REIT, you can buy and sell in an instant just like any other stock. With these private REITs though, you might have to wait for the quarter end to withdraw your money or for that lockup period to expire. Next we get to the direct investment strategies, and the first one is to seek money partners. I really like this one and have actually been on both sides of the table. So here you're finding an investor to put up all or part of the cash investment while you manage those properties. Now this is more common in those shorter term investments like flipping a property or maybe a development deal, but I have seen it in some of the longer term management structures, but it's pretty rare. Now with this kind of a deal, it helps to have some experience and know some of those investors in your area. You develop a reputation as a good property developer, build that reputation with those local investors, then all you have to do is scout properties and buy. A lot of times you're going to set this up as a limited liability company or an LLC with both of you owning the property. Now the investor fronts the money to buy and rehab it, you put in the management and that sweat equity, and then you split the profits in the sale. After that, the LLC dissolves or you move on to the next investment. Pros here are that lower capital commitment, though most investors still expect you to put in some of that money on the project as well. You get another set of eyes on the project. That investor approval really helps to thin out some of those weak projects. Cons though are the experience and the time that it takes to build those investor connections and then get to that yes. Most investors aren't going to trust their money to just anyone, and you'll have to provide constant updates on the progress. Tax liens are one of the best passive income sources you can find with property, or really any investment out there. So anyone that owns their home knows that the county collects taxes on every property in the district. If those taxes aren't paid, a lien is going to be put on the property and it can't be sold until everything's caught up. Well, the county needs that money to fix that pothole on Elm, so it's going to sell the lien to an investor at an auction. Now this investor buys the lien, collects an interest rate plus the lien amount over a period of years. What's great about these though is that the county is going to continue collecting those back taxes and then just passes that amount owed on the lien directly to the investor. If the lien isn't paid, you might pick up that property for pennies on the dollar. 29 states sell tax liens, while others sell the deed outright and some kind of a mixed approach. We'll look at the process for liens because that's really the lowest risk and a great investment. Now understand also that you don't need to be a resident of that state to buy tax liens. In fact, I used to go to Cook County in Chicago and Fulton in Georgia all the time to buy liens. The interest rate you collect on liens can range from 10 to as high as 36% in some states, and the time owners have to redeem these liens can go as long as 4 years. That's going to mean you could lock in those rates for as many as 4 years. Now, tax liens work in a couple of different ways depending on the county where they're sold. If a property owner falls behind on their taxes, the county's going to put that lien on the property and then put it on a list for the annual auction. Now you have to register for these auctions and grab a list of the properties, sometimes months in advance, so make sure you're planning ahead. And when you get to the auction, it's either going to be a bid down on the rate or a bid up on the price. So each property is going to be called in, and then investors are going to bid the rate on the lien down, or they'll bid the cost of the lien up. Now both processes are basically the same, and it just means you're going to be getting a lower rate than that maximum allowed, but you're still looking at a 12% or higher for most liens. Pros of tax lien investing are those high rates you can collect. I've earned as much as 24% on some of these liens. It's also almost completely passive since about 90% of these things get paid off by either the homeowner or the bank. Cons though are that it takes some research to sort through all these properties, and you might have to travel to these different counties or the states to find enough to invest all your money. Some of these liens are in thousands of dollars, so you'll need to keep up with those subsequent taxes as well. House hacking is my favorite way to get started investing in rentals, and I've got a twist to make it lower cost. Now this is where you buy a duplex or a triplex, live in one of the units, and then rent out the others. Since the property is owner occupied, you can get approved for some of these lower down payment loan programs like the HUD loan or a VA loan. So technically, I know this isn't something you're going to get started with just $1,000, but I had to include it here because it's such a great opportunity. You'll need just 3.5% down payment on a HUD loan, which can be less than 10 grand even for a really nice property. And rates are low enough right now that a lot of times your tenant rent is almost going to be completely covering the mortgage payment. This is a great way to start real estate investing, getting that first property without that big down payment. You do this for 5 years, refinance the property for a cash out, and you'll have enough to buy another investment. Pros of house hacking include those low down payment programs and really low interest rates right now. It's easy to start, and management is easier because you've got just 1 or 2 tenants and they live right next door. Cons are that it's going to take some time to save up that down payment, but it's still less than half of what you'd normally have to pay down for a regular loan. Now, any of these strategies make for a great start in real estate investing, but I want to share 3 secrets to success that are going to help you no matter which direction you choose. These 3 tips are not only going to help boost your returns, but they'll avoid a lot of the biggest mistakes made by property investors. First is just negotiate like you don't want the property. When you're talking about properties starting out at $200,000 or $300,000, even negotiating 5% off the price is going to save you more than 10 grand. You need to use every trick in the book that you can here. First is just to know how much similar properties have sold for in that area. The seller or the agent is going to provide their own list, but this is always cherry-picked to show the highest prices. Instead, what you're going to want to do is visit the county assessor's website and make your own list. You have properties sold in the area roughly the same age, same use and size, then put together a median for the per square foot value and start negotiating at 85% of that value. Starting the negotiations, remember, you can ask for property improvements, closing costs, all kinds of things besides just that price. And using these as ammunition to lower your total cost in these negotiations. Now, my next tip here is to consider both commercial and residential property in your mix. I know residential rentals are by far the most popular property type, but don't overlook those commercial investments either. In my experience, commercial properties like retail and office space just require less management, and the tenants don't tear up your place. You can even sign a lot of these on a triple net lease, triple N, which means the tenant pays for all the maintenance and the services. You just sit back and collect those checks. Third here is use a mix of direct and indirect real estate strategies. Starting out, you might not have much of a choice. Invest in those indirect strategies while you build your down payment for a direct property purchase. Now, even when you are able to buy that first property though, investing in these real estate funds gives you that instant diversification across property types and in different cities. There's no management time for these fund investments, and you'll get that tax write-off with a direct property investment. It's really the best of both worlds. Click on the video to the right for my 5 favorite REIT stocks. 5 REITs with dividends up to 10% and more and great potential. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.